QuickBooks Pro Desktop 2021. Foreign payable and forward contract maturity transactions. Let's get into it with Intuit's QuickBooks Pro Desktop 2021. Here we are in our practice problem 4. We have our open windows open. You can open the open windows by going to the view dropdown, selecting the open windows list. In prior presentations, we made a purchase of property, plant, and equipment on account, paying for it in the future, therefore having a payable on the books in foreign currency that we'll be paying in the future. We then set up a forward contract to mitigate the risk related to that account payable that will be in the future. We made adjusting entries for the accounts receivable and payable accounts to make them correct as of the cutoff date, the end of the year. Now we're going to be thinking about the ending, the termination, the paying of both the accounts payable related to the purchase of the equipment that will be done in foreign currency, as well as closing out the forward contract that includes a receivable component to it in foreign currency. Let's check it out. Go into the reports dropdown, company and financial, taking a look at the balance sheet standard. We'll change the dates up top in the customized reports from 01/01/21 to 12/31/21 and then say OK. So here's what we have thus far. We've got the receivable on the books, and this is the one that's going to be in foreign currency, so that'll be one of the more confusing components. The receivable is going to be related to the forward contract. We have the payable on the books. The payable on the books was a result of us purchasing the equipment. We purchased the equipment, put the payable on the books using the spot rate at the point in time of the purchase. Then double clicking on this, we adjusted it at the end of the year, 12/31, for the change to make it correct for the financial statement date, even though it had not yet been paid. Closing this back out, we also have the forward contract resulting in this receivable, and we had to adjust it at the end of the year, double clicking on it. With this adjustment here, the two are not exactly the same because we had to use two different rates, the forward contract using the forward rate, the other using the spot rates. So I'm going to close this back out. Now we want to think about what's going to happen when all this becomes due, when we have to pay off the payable down here for the contract that we had to pay off for the equipment that we purchased, and we're going to receive the receivable at the same point in time, and we're going to pay off the payable to the exchange broker all at the same point in time. Let's first consider that in Excel, and then we'll break it out component by component over here in QuickBooks. So Excel is a little bit more transparent. In Excel, this is here where we stood last time. We had the ending balances, basically same scenario here. The gain or loss down below, we're going to take these ending balances. Those will be our beginning balances for year 2. Only difference being that the equity section or the income statement will close out to the equity section. Therefore, equity section at the 99,300 starting point, 99,300, nothing in the income statement, in our case only showing the gain or loss related to these transactions. So now we're going to say that this thing is going to close out. The end of our period here is on 3/31 because both the payable is going to be due 120 days from the point in time we put it in place, as well as the forward contract, which has both a receivable and payable component to it. The two sides that we need to be concentrating in on are, of course, these foreign currency items. So within Excel, we're going to revalue these two items first and then think about what we can go from that point in time. So we're going to revalue them to where they're going to stand at the termination date using the current spot rate. Okay, so I've moved the yellow square down here into our second trial balance to make sure we're concentrating in on year 2 here. So we're in on year 2. We're looking at the accounts payable, which is the $61,000, what it's currently on the books for. We're going to see what it should be valued at this point in time. Let's go back to our rates. And we then have the rate that we're going to be using. The termination is at 3/31. So at 3/31, we have the 0.602. So I'm going to take the 100,000 times the 0.602, and that's what it should be at this point. Note that both the receivable and the payable, both the forward contract and the item we had on there, the payable from the original purchase, are going to be using the spot rate at this point. Why? Because the forward contract rate was speculating forward till this point in time, till this spot. We are now at the spot that we were forward or projecting towards. Therefore, we can use the spot rate for both. So if I go on back over, I'm going to say, all right, so we had then 60,100 before. It's going to be decreasing. So I'm going to say 2, and I'm going to say minus the 61,000, and it's going to be decreased by the $800. So that's kind of good for us because the accounts payable then is going down. Let's just analyze that real quick. Last time we used the rate of the 0.610. This time we're using 0.602. So what happened here? Well, $1 Australian could purchase 0.61 US dollars before. Now $1 Australian can only purchase 0.60 US dollars. The Australian dollar got weaker. We're talking here about a payable. We're going to be paying in Australian dollars, which got weaker than when we first made the contract or at the last point we looked at it. And therefore that would be good. That would be basically a gain for us. So we're going to say, all right, then the payable is going to go down with a debit. So we'll go to the payable here. It's going to go down with a debit. And then the other side is going to be going to the gain. This is going to be a gain on this transaction. Let's calculate it again. So this is going to be equal to, I'm going to do it this way this time, brackets. And then I'm going to take the larger number, which is the 0.602 minus the smaller number, the 0.610. Don't let that 131 kind of mess you up, and then brackets around it. That's not a bracket. That's the bracket. Times the 100,000. The 100,000. There's once again our 800. It's backwards here because I took the larger number. So I'm going to double click on it. I'm just going to put a negative in front of the first bracket, simply flipping the sign, multiplying it in essence times -1. So flipping the sign, there we have it. And let's record it out now. So the accounts payable down here, accounts payable is going to be equal to, we'll pick up the payable on this side. Then we want the gain down at the bottom here. The gain is going to be the credit. It's going to be represented with a negative number, but it's a gain because it's a credit. And so there we have that. So we've recorded that side. And this, of course, gets us to that 60,200, which is where we needed it to be, because that 60,200 is represented as the 100,000 foreign currency units times the 0.602, 60,200. So now let's do the same thing for the other item, which is a foreign currency unit, to revalue it. So I'm going to unyellowfy this. It's been unyellowfied. And I'm going to yellowfy the receivable. That one's going to be yellowfied. This one is a result of the forward contract. So let's revalue that one. So we'll do the same process now. And this, we're going to see some repetitive numbers here, because this one, what should the receivable be valued at this point? 100,000 times the 0.602, the spot rate. And notice we were using these rates before. Now we're using the spot rate because we're at this point in time. We're at this spot. There is no speculation forward because this is the ending point. So we're going to say that equals, once again, that 60,200. And if I scroll on over here and say, well, what's in there like right now? We have the 61,200. So we're going to have to decrease it. So I'm going to say minus 61,200. And that's going to be a $1,000 difference. So we've got a $1,000 difference that we're going to have to be recording. We're going to make it go down, and that is kind of like bad for us, right? Because it's going to be decreasing. Why would that be? Well, before, last time we used here this rate, the forward rate for the forward contract. So we had $1 Australian can purchase 0.612 US dollars. Now $1 Australian can purchase 0.602 US dollars. Therefore, they can purchase less US dollars per Australian dollar. The Australian dollar got weaker. And this time we're talking about a receivable. So the receivable is something that we're going to get paid in the Australian dollars, which have now gotten weaker. And so that would be basically not good for us. So that would be the loss. That is exactly what you would expect, because it's basically, we put that in place to kind of net out against the gain that would be a result up top, to kind of mitigate the potential for a loss for the risk of the foreign currency when we had the payable. So this should be going the other way. So we'll say that kind of makes sense. So then I'm going to say this is going to be a loss then. And then the other side is going to be going to the receivable. I'm going to calculate it again, doing it this way this time. This equals brackets. Let's take the larger number first this time. So I'm going to take the larger number first, which was this one. This is what we were at last time with the forward contract, the receivable, minus this one. And then bracketize it, and then times, and we'll take the 100,000. That once again gives us that $1,000. So that looks correct. Let's go ahead and post it out. So scrolling down, we're on the financial statement. This is going to be equal to the $1,000 debit. So that nets out to $200. And then we have the foreign currency receivable here. That's going to be equal to, and we'll pick up the $1,000 credit, bringing that once again to that $60,200. So that everything kind of falls into that $60,200 because we're basically at the same spot rate at this point in time. So now the next component, you can do it in some different orders, but let's think about the forward contract first. And we have the easy part of the forward contract is the dollars payable to the exchange broker. So let's take a look at that piece first. And I'll say, let's yellowify this box. That's the one we're going to be working with. Now, this one hasn't changed since we put the forward contract on the books. In other words, if I go back up top, we put the forward contract on the books. This payable went on the books. Nothing happened to it since that point in time. So we have that $60,009 on the payable. Nothing has happened to it until now. Now we're going to simply pay it off. We'll pay it off with cash. It's in cash. We don't have to deal with any foreign currency related to it. So we can do that first. Let's do that and say this is going to be equal to the payable on the debit side of things. The credit side of things is going to be cash. How much are we going to pay off? Well, we're going to be paying the $60,000. The $60,900. If you want to see how that was calculated, it was calculated as this would be equal to the 100,000 times the original forecasted rate when we first put it on the books. This is the same calculation to get this number right there. So we're just saying that's the calculation for it. The other way just to see it is the negative. You could say negative of that number. That's where we're pulling it in. And obviously, you can also pull it from this number too. It's all the same area. So then we can record this. I'm going to say the cash then is going down. So I'm going to say this equals the cash is being decreased with a credit. So that's the credit. Posted the credit first. And then on the payable, this will be equal to the debit, bringing that payable on down to 0. So that payable is going to 0. I'm going to unyellowify this. Let's unyellowify this. And then the next one, let's talk about the receivable for the forward contract. This is the other side of the forward contract. We're not talking about the payable related to the purchase of the asset yet. So this is for the forward contract, the other side of the forward contract. And this is the one that's in the foreign currency. So this is the one that was in foreign currency. We're going to be receiving now 100,000 units of foreign currency units at this point in time. 100,000 units of Australian dollars, which we have valued at the current rate. So now we're going to say that this then, we're going to get the money, the receivable is going to go down, we're going to get basically cash, but we're going to get the cash that's going to go into the foreign currency units because we're going to get paid 100,000 foreign currency units, which we then have to value in terms of the US dollar using the current spot rate or exchange rate. Then the other side is going to be the receivable is going to go down. The calculation for it will look familiar. We could calculate it again. It's going to be then the 100,000 units that we're actually going to be receiving in Australian dollars, then times the current spot rate as of this point in time, because it's all happening. This is when everything's going to be done at this point. So that's the debit, that's the credit. Recording this out, we've got the foreign currency units that will then be increasing. This is like cash, but in foreign currency, 100,000 units in the bank, which we're now valuing at the current US equivalent value, which is 60,200. Once again, we see that number. Other side's going to be going to the receivable from the exchange broker, which should bring it down to 0. So we have the receivable from the exchange broker that's in it. I'm going to double click on it. Something's in it plus, and that'll be then the credit, which will bring it then down to 0. So that now is at 0. Okay, so I'm going to unyellowify this one here. Let's unyellowify this little square. Now we have the foreign currency units, which I'll yellowify because we're going to use that one next time. And then we're going to use those units, which that represents 100,000 Australian dollars, to pay off the payable. This is the original payable that we had on the books, or the payable we had on the books that relates to the purchase of the depreciable asset, the property, plant, and equipment, which we revalued currently to the spot rate right here. So we got those two that are going to be zeroing each other out. They're equal and opposite at this point, so we can just take that 100,000, take it out of our foreign currency account and pay off the accounts payable. Those both revalued now according to the current spot rate. So we're going to say, all right, now we're just going to pay this thing off, and then that'll be it. Then we'll be done with this thing. So we're going to say we've got the accounts payable. The other side's going to be to the currency units, foreign currency units. We can calculate it again, but we know what that number is going to be because we've done it like a few times now. It's going to be the 100,000 units. That's what we're actually paying in, times the current spot rate, 0.602. Once again, we have that 60,200 debit and the credit. Let's go ahead and record this out. So the payable here, something's in it. Going to double click on it, go to the end of it, plus, put the cursor back down. We're going to be picking up accounts payable, bringing it down to 0. Other side then going to the foreign currency units, something's in it, double clicking on it, say plus, and then we're going to put the cursor back down. We're going to be picking up the foreign currency unit, bringing it down to 0. So this is where we stand at this point. We got the cash, we got the depreciable asset. Notice it didn't change. The depreciable asset didn't change. We put it on the books at the spot rate when we first purchased it. Up top didn't change since that point in time. What did change is the value of the receivables and the payable that we had for the forward contract and the purchase of the equipment, and the difference between them, instead of the difference, for example, the difference on the payable for the foreign currency did not change the depreciable asset, but instead was part of the transactions recorded down here in the gain or losses. So these gain or losses then net out here to the 200 for year 2, and up top they netted out to the 700 in year 1. So now we got to think about how we're going to do these transactions. We'll break them out into a couple different transactions into the QuickBooks system, and we'll take a look at that in a couple different components, a couple different pieces. We will break out a little bit differently. Instead of having to do these two revaluing journal entries, we will do an adjusting entry and a reversing entry, and that's kind of the little tweak, the little twist in the system that works really well logistically in accounting software, but can be a little bit confusing. That's where we'll deviate here a bit, but once done, it should be an easier process to do. So we'll start that next time.